tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
All right, I will go ahead and dive in. Yeah, I was almost ready to go, and then Apple made me do a reset, which closes all the boxes. And then Brave made me do an update, which closes all the boxes. Anyway, hello. I won't bore everyone with going through all this stuff. However, there was some cool twin news, some cool twin updates, announcements, stuff like that. So that's neat. The Deepak twin, you can go play with it. That's pretty, for those of you that are kind of into that, that's cool. There is Jupiter Dex news. There is, Michael Saylor news isn't really Michael Saylor news. They borrowed a bunch of other people's money to gamble into Bitcoin. But what you are seeing is, apparently, if this news is to be appreciated, Bitcoin miner reserves have plummeted to a 14-year low. You say 14 years? If I do the math and go back 14 years, that's pretty much the beginning of Bitcoin. Yep. So, I guess we'll talk about that real quick. And let's see. The basics are miners' Bitcoin reserves hit their lowest level since 2021. It's funny that they say lowest in 14 years, and then 4 lines later, lowest in 2021 since 2021. Is that 14 years? Anyway, miners' OTC sales, over-the-counter sales, meaning not pinging the exchanges, rise to their highest daily volume since March. So we chatted about that. I don't know if it was Monday or yesterday, but we kind of said, probably most of the miner activity is OTC. Otherwise, it would just completely collapse this old illiquid-ass market. Anyway, so miner OTC sales are their highest daily volume since March. Why? Because they're having to sell everything but the kitchen sink to stay in business. So they're selling all their reserves, their stockpiles, which they were using as investment. And the dollar value of miners' reserves remains near an all-time high. Why? Because Bitcoin is very expensive. I mean, comparatively. So there you go. All right. Miners' Bitcoin reserves have fallen to levels not seen since 2021, currently standing at approximately 1.82 million Bitcoin. It's not bad. After starting the year with around 1.87 million Bitcoin. All right, so miners have unloaded about 50,000 Bitcoin, which is not nothing. This decrease in reserves has remained constant since October 2023, while the price of Bitcoin has seen a 150% increase during the same period of time. The trend reflects the miners and their strategy of selling more Bitcoin to cover operating costs and maintain profitability, or to just stay in business, especially after the recent reduction in block rewards. As miner reserves dwindle, so they're dwindling, OTC sales have reached their highest daily volume since March. So a lot of the activity is going on privately, OTC. These private sales, they allow miners to liquidate a crap box full, an S-ton, you might say, of Bitcoin without directly impacting the market. Why? Because they're OTC, kind of like node market. They're wallet-to-wallet transfers. They're not pinging an exchange and destroying order books, things like that. So it avoids potential price problems. Despite the decrease in BTC reserves, the dollar value has remained near its all-time high, around 135 billion. This is a consequence of the significant appreciation in the price of crypto assets, such as Bitcoin, to a lesser extent, Ethereum. See, Bitcoin miners don't just hold Bitcoin. Many of them build their own little funds, their own little kind of index funds based on their, belief systems, cultist, laser-eyed activities. So they have a basket of assets, many of them. It's not just, I mine Bitcoin, I hold Bitcoin. Many of them put the profits from Bitcoin into other assets as a hedge against Bitcoin, but also, there's a little bit of speculating in there. The behavior of miners in selling more Bitcoin is also influenced by the recent block reward reduction, known as the halving, Halving. And the last halving occurred in April 2024, which reduced the rewards from 6.25 Bitcoin per block, per 10-minute block, to 3.125 Bitcoin per 10-minute block. And this affects, obviously, miners' margins and forces them to sell their reserves to pay for their, to keep the lights on and pay employees and do their upgrade cycles with electronics and equipment and knickknacks, things like that. So why would you care? Well, the decline in market reserves and increase in OTC sales reflects a strategic adaptation to current market conditions and economic pressures. And basically, many of the miners that you would have thought they had this covered, they just weren't prepared. And so since we haven't seen a full double in the price of Bitcoin since the halving, people that were barely making money at the halving are going bankrupt or slowly eroding. So they're basically gambling. Like, listen, if Bitcoin doesn't get to a 2x, what is it, 86,000, something like that, then they're gone. They're just out of business and they're done. Yeah, see you later, bye. So these sales increase the supply of Bitcoin into the market, but OTC sales don't necessarily, because a lot of that might be going on balance sheets of investment funds and, the other kind of idiots like Michael Saylor that just blindly invest other people's money in his gambling habits. So there you go. There's been a lot of demand retail-wise and ETF-wise, and it's probably why this kind of behavior, this probably would be much worse without the ETFs. So anyway, according to data from CryptoQuant, retail investors are exhibiting fearful or disinterested behavior. So just keep that in mind, those of you out there that are both fearful and or disinterested. Most of the retail activities in wallets that have held Bitcoin between 3 and 6 months. So, the Johnny come latelys, the new people that while Bitcoin was going up, they were telling everybody how smart they were. And now that Bitcoin's just kind of flat, they're quiet, or they invested with leverage and they're bankrupt. Anyway, so Bitcoin's just kind of been stagnant, but it's been stagnant up 150% on the year, which is good. It's a lot. So the usual kind of fear and uncertainty and doubt and, being unsure about your brand new investment is pretty typical, especially when we bring in a bunch of new retail investors, like a new flock of adoption. So you also have a lot of whale accumulation, which those are, whenever you hear that term whale, those are just people that have a lot of money. Whales, guy's a whale. They got a lot of cash, a lot of money, a lot of investments. A lot of the whales were made whales by sheer coincidence and whimsy. They had $10 worth of Bitcoin in 2010. They didn't think of anything of it. Then by 2016, 17, 18, they're $10 worth of they're $100 worth of Bitcoin. They're $10 worth of Bitcoin made them multimillionaires. And now they're giving speeches about the future of finance. Because that's the funny way the world works. None of these people knew what was going to happen. None of these laser-eyed, even laser-eyed, goofy Michael Saylor, he thought Bitcoin was stupid in 2013. He was like, this is dumb. And he was public about it. Stupid. And then he looked back into it and I don't know, went to Vegas, got his ass kicked there, got kicked out of his apartment, decided to invest other people's money in Bitcoin. I don't know I don't know the origin story of his orange pilling, but he thought it was dumb. Then he didn't. Then you have people like Nouriel Roubini who thought Bitcoin was amazing, then went the other way. And he's just been mad because he had one call one time with his black swan thesis, and he's never been right since then. And he's just an angry, kind of quasi-sophisticated academic with no real money in the game. It's interesting. You can be really academic when you got no money in the game. After that, you just got to be about the math. Anyway, so this dynamic, this Bitcoin miner dynamic is indicative of probably overall confidence on the ETF and retail investor side, and panic, fear, flipping panic on the side of the miners that are just slowly going bankrupt. And if they didn't upgrade in time, or if they didn't invest their money correctly, or what have you, they're slowly going bankrupt. So there you go. Yeah. So we were up to about 66,000 this morning, and then it just kind of went away. Anyway, yeah. So we're going to talk gambling. We're talking about some gambling later. Some crypto gambling. Let me see if I go to this one. Oh, that one's okay. That's better. The part of the brain and the mindset that deals with gambling and those kinds of thoughts versus long-term investing kind of mindset. Those are different. Yeah. The other thing I thought we would talk about is Jupiter. So the Jupiter Dex, many of you read this. And if you're staying up to date, a good way to stay up to date is if you get Livecoin Watch, the app, there is a news feed, and you can go through that news feed. And in the news feed, you can curate the news aggregators that you think are cool and the ones that you think are bullshit. So you can get rid of those. So what you do, matter of fact, come on, man. Open, you son of a smoker. Let's see. If you go into Livecoin Watch and then you go to news and then you go to the little geary thing, then what you can do is you can get rid of the crappy companies. I'll see if I can show you. Camera. Let me make the thing big. Let's go here. Okay, so when you go, you have a news feed. News. Let me see if I can show it. See the little news feed? It's got all these articles. It's got tons more articles. See the little gear? There's a little gear right here. If you touch the gear, whoop, it's not it. Go to news, touch the gear, then go to edit. See where it says edit? You can edit right here. And when you edit, you can choose, you just unclick the boxes of the companies that are, putting out meme coin bullshit and gambly stuff. And, oh, this new coin's going to be better than all these other coins. And here's how they do it. Here's Scammy News 101. If anybody wants to know how Scammy News works, you have a little article that says, oh, top 5 coins in crypto. And they'll say like Bitcoin, Ethereum, Cardano, Scam Coin, and then something else. So they'll what they do is they put an article that's 80% truth, and then they just sprinkle in 20% bullcrap with their dumb little coin. Onyx Zephyr token. Shut up. So anyway, when you see those news sources over and over, just get rid of them. Just take them off of your news feed because they are crap. They are crap and you don't want them. Howard, don't try to act like you're a pro at it. You don't even know what the hell I'm talking about until 13 seconds ago. Now you're like a pro. I'm a pro at news aggregation. If you were a pro, you wouldn't have been talking about all that meme coin crap last week. I don't want to hear your stuff, buddy. Go and fish. Just keep the show on while you fish, Howard. Let the adults do the investing. Anyway, so yeah, you want to curate that stuff, but you do want to keep abreast of the news. So that's where I get a lot of these news things. Then you can go research it. You can take that news. You can read a little bit about it. The news will have links. Go through those links. You know, there's usually 3 or 4 links, similar articles. You can find out if what you're reading is crap or not. That way you can do your own research. DYOR, bro. You didn't find a gear. You don't even know what a gear is, Howard. Anyway, he does probably know what a gear is. I think everybody knows what a gear is. All right. Let's talk about the Jupiter DEX tokenomics things. Jupiter DEX, which is decentralized exchange. You hear DEX. When you hear SEX, oh wait, they don't say that. CEX, centralized exchange. Yeah, I could go down a whole path there. Anyway, I won't. Jupiter plans tokenomics transformation to boost the Jupiter token value. I'm actually surprised this token hasn't banged up by at or around 30%, just based on this news. Anyway, Jupiter DEX proposal to reduce the total supply of Jupiter tokens by 30%. It's a big chunk. That means out of 100, they're getting rid of 33.3 tokens. The renewed focus is on a more sustainable and community-focused token economy. The decentralized exchange team's commitment to supporting long-term community initiatives. Ooh. Anyway, there's a lot of little bits and pieces, but essentially the measure proposed by the founder known as Weir Meow, which I like this guy because, you know, meow. Anyway, it aims to optimize the token's valuation while actively involving the community. This is tantamount to a token burn, really. Token burns are usually, I'm not a fan of them, but I'm not a fan of Solana. And this is a DEX that leverages Solana. So this is my picks and shovels play against that. If you're interested in it, go take a look. You know, you got to be, we're not going to really talk about the investing in or around this, but if you're interested in the kind of idea of having participation in a DEX where, you know, compared to like Uniswap, where Uniswap has a token that's been going up for no reason. Investing in Uniswap to me makes no goddamn sense. It delivers nothing. It does nothing. It gets you nothing. There is zero benefit. It makes no sense. So when people get in and out of it, it's a purely speculative play. And as we'll see in a little while, that is dangerous. Not dangerous, that investment. Investments are investments. Sometimes they go up, sometimes they go down. That kind of mindset is dangerous. Those are 2 different parts of the brain you got working. And they're not best friends. And it is a tragic flaw in investing, and it will limit you. Now, most people will be like, oh, it's no big deal. I gamble because I enjoy it. And all the kind of self, whatever. Anyway, in this case, this is less gambling. Now, you are speculating that Solana survives. But in this case, at least the token is a little bit more correlated to the success of the DEX, right? So the DEX does better, then you do better owning this asset. Again, I'm not telling anyone to get it. It is a super tiny position in my bag of assets. But yeah, so there you go. But anyway, the community is getting a little boost Now, what they would have done years ago is it would have just been promoted as a token burn. Oh, we're going to burn tokens. You say, why would you burn tokens? Well, to make the price go up. Okay, but then why did you mint those tokens? Why did you mint all these tokens just to go and burn them? No, when you go back and do a burn, or when you do something like this, so this is where I'm going to take the other side. Everybody's like, yeah, this is awesome. Well, no, this is a token burn, and this is a team that made too many tokens. So if you have to burn a third of your tokens, why did you have that many tokens in the first place? You either misread, misunderstood, or don't understand the landscape, or there is no landscape and you're just making it up as you go. You don't reset your tokenomics by a fucking third. That means you got a 67 in math, right? I mean, I guess that's passing in some states. What do they round that up? I guess if you got a 67 in med school, they call you doctor now. Anyway, so I guess I'm kind of on both sides of it. I'm like, yeah, it's cool. If you own the token, I guess they're going to try to force the price up. They're doing some other things too, not just this token burn. Sorry, I mean a token reduction in supply. But I'm always a little bit suspicious when people come back and do these broad scale token readjustments. So yeah, we'll see. The proposal includes a significant reduction in token allocation for both the team and future issuances, signaling a move towards a more inclusive and transparent governance structure. Okay. This reflects a shift towards a more sustainable and fair token economy. I don't know how it's more fair. You have X amount of tokens. Now you're going to have 67% of those tokens. I don't know who jumps up like, yeah, this is so fair. It was so unfair. It was a third unfair, but now it's going to be fair. It doesn't make any damn sense. It seeks to align the long-term interests of users with the growth and stability of the Jupiter ecosystem. Well, not if base takes off. Anyway, these dexes are cool and they're interesting. I like that with Jupiter, you get to vote on stuff. I like that you get to participate. I think most of this is marketing. And yeah, the founders are like, yeah, we're going to reduce the supply. We're going to lock up our own tokens. We're even going to reduce our own tokens by a third. Yeah, that's what reducing the token supply by a third is, because math, you dicks. They're not doing us a solid. And so don't go read into this and be like, what a wonderful, benevolent team that's just really looking out for the little guy. Bullshit. They're trying to pump the price of the token, and they think they can pump it by more than a third by whacking, chopping, lighting on fire, vaporizing a third of the tokens. This is self-serving shit. This has nothing to do with pro community. So don't buy into that crap. This is all about these dudes lining their fucking pockets. I'm okay with that. You know what I mean? Like, if it's what's good for the goose is good for the gander, but be honest about it. They act like it's a cool thing. Listen, we're going to cut the token supply, even our own. Yeah, no shit. That's what a token burn is, dummies. That's what cutting the tokens means. No one thought you were going to cut the other tokens and leave your stashes 100% whole. Stupid. Oh, man. Anyway, so there you go. The team emphasized their commitment to community by betting on long-term stability. They locked their tokens up for an extra year. Whoa, look at that commitment. With the decision to keep tokens staked for extended periods, they seek to avoid supply shock and ensure organic and sustainable growth. Their new strategy, called CEF, Community Eats First, reinforces trust in the project by demonstrating complete alignment of interest between the team and users. No, it wasn't the users that said, let's cut a third of the tokens. This is the complete alignment of the team among the other team members. Looking ahead, Jupiter Dex has significant ambitions. No shit. Is there anybody here who does not have significant ambitions? Please, please, please raise your hand. There's 183 people here. Those of you with no ambitions, please chime in. Say, my name is Steve, and I have no ambitions. That's my uncle. That's my Uncle Steve. He's a piece of shit, by the way. Anyway, just saying. Just like my psycho grifter ass grandmother. Anyway, yeah, so I don't know, man. A lot of this stuff, I wish they would just say what it is. Listen, we're gonna burn the tokens. Just be honest about it. Don't try to make it community eats first alignment of the global. Shut up. They have ambitions to become a global unified marketplace. Okay, all right. Offering comprehensive platform for diverse financial use around the world. Although these goals are ambitious and mostly impossible and require extensive collaboration, which they probably won't get, Jupiter is positioned to lead innovations within the DeFi space. That means nothing. Lead innovations. We're gonna lead innovating. What? You're gonna innovate? Yes, we're gonna lead it. How do you lead thinking? We're gonna lead thinking. Today, we're thinking 30% more with 30% less. I don't know, man. Seems a little bullshitty. But should be good for the token price. And no, Bill, I probably have more Jupiter than your entire portfolio. Just kidding. No, I'm hating on it because this token burn thing, this whole slashing of tokens thing, it's the same. I'm not just hating on Jupiter. If you've been listening, I was hating on Uniswap. All of this DEX stuff is bullshit. DEXs aren't unique. You can spin one up in 13 seconds. Everybody here, you can go and spend about 20 minutes learning how to fork an asset, and you can spin up your own DEX. Everybody here, there can be 181 DEXs. Everybody can have a DEX. No one gives a shit. And we're leading thinking. Yes, Donna's leading thinking today. Yeah. So I guess what I want you guys to be thinking is just don't buy into the hype and bullshit and whimsy of these little stories that come floating around. Jupiter will do good if Jupiter does good, if people use it a lot. That's why Jupiter will do good. Jupiter won't do good because of token burns or locking up tokens or any of this other shit that no one cares about. And it has nothing to do with the actual use and utility and wide-scale adoption of that DEX. Same thing with Uniswap. But Uniswap, the difference is, if you're on Ethereum, Uniswap is the leader. The fact that Uniswap has no value, the token has none. It should be fucking zero. It doesn't do anything. It doesn't make any sense. Now, they could make some adjustments and they could say, listen, we're going to do this new thing where this token represents some fee sharing or where the token represents reduction in this or that, or, whatever. There's all sorts of things you could do. They've just chosen not to do these things. So at present time, these DEX tokens are fucking worthless. All of them. You say, yeah, but I get more tokens if I vote in the things. Jupiter, listen, I own it. I'm going to bash the things I own if they're bashable. So you have Jupiter tokens. Cool. Jupiter does well. Do you do well? I mean, kind of, because you get some airdrops once a year. Okay, cool. You get to vote on some stuff. Cool. It's nice to participate. You don't vote on anything on Uniswap because tokens launch as quick as possible because Ethereum. So, I mean, what are you really getting? You're getting a token, and you might get more of those tokens. You might get some other tokens that launch on a thing. I guess that's cool. You get some airdrops of some tokens that you wouldn't know about and that no one would probably know about if they weren't on Jupiter. So wait, so you're selling to a small group of people a token that they would have never known about and giving them some of those tokens for the token they would have never known about to build an economy so that the people that built the token can get some nice ass Lambos. Got it. Cool. It all makes sense now. It all seems super fair and super legit. There's nothing special about DEXs. None of them. What's special is if they're easy to use. If it's easy to use, if it doesn't crash and the fee structure is amenable, that's a good DEX. There's nothing unique about these DEXs. Nothing. No, I don't want to. I'm not trying to tell you to do or not do anything. People love token burns. They're idiots, but they love them. They don't realize that a token burn equals a poorly mathed out, poor design consideration team, a team that doesn't think about the future. Token burns are one of the red flags that tell you that a company, math-wise, doesn't know what they're doing, that their economics and that their economic forward thinking is flawed. Right? So there. And again, trading is fine if you're just to understand what you're doing. Listen, you can jump in, make a trade, make some money. That's cool. We want everybody here to make money, but you have to be aggressively antagonistic against your investments to make sure that you're honest about what you own. Don't be the dude that wins the lottery and then goes and gives financial advice. Don't be that dude. Just understand what you own. These DEXs are all sketch. The tokens don't mean anything. It's a funny money token. So you just have to be aware of that. Now, you may still make a lot of currency units by getting into one of these things, riding the trend and all that, but be honest about why you own it. Don't be caught up in something about utility and world changing and all that other kind of bullshit. Just be honest with yourself. Hey, I'm buying this thing because I think it's a good flip. I think a bunch of dummies will dummy into it because they're doing a token burn. That's what that article should be. So, and also, nobody here has to agree with me. Me and Brandon disagree about all sorts of stuff. He makes money on stuff that I would never touch, and I make money on stuff that he would never touch. It doesn't mean the money wasn't made. You still made money. If at the end of the day, if your portfolio is better off than it was, it doesn't matter. Just understand why you're doing the things that you're doing. The why is always much more important than the what. You say, well, what are you buying? What difference does it make what I'm buying? You should think about why. And then each of you will form your own kind of version of an investment methodology, an investment thesis. You'll have your own rules. Maybe the 10x take 20, 2x take 10 thing is a little bit thick for you guys. You guys say, I don't want to wait for a 10x. Maybe it never happens, this, that. Like a 3x or a 2. Yeah, that's fine. Everybody here has to have their own investment methodology and thought process and risk tolerance. You got to listen to your risk tolerance. But at the very least, challenge these bullshit news articles. You know what I mean? And be aware when you're gambling. Don't kind of, oh, no, this is an investment. No, bro. Be honest with yourself. I know. I bought Sia coin yesterday. I tried to. I couldn't get filled. Couldn't get filled on Sia coin. It's pretty illiquid. That little crappy coin. I mean, when I say I bought it, I spent like $320. It's not like I bought it, but I got some. I was like, oh, okay, there's extra in that account at BitTrue. I'm going to buy some Sia coin. It's dog shit, that project. It's absolute garbage. Terrible team. It doesn't, man, it's borderline Singularity DAO. That's how bad it is. I know. I said it. It's almost a curse word. But I'm very clear with myself. That is a stupid, dummy gambling tactic because, and my thesis backing that is, people will buy quality big data assets, which, by the way, that whole story has been really perverted in the media as far as what big data is and what it isn't. What it is Filecoin and things like that, projects that, deeply protect, aggregate, encrypt, shard data, right? Protecting humanity's fucking data. What it isn't is Render and Graph Token and these other spammy, fake Johnny come lately ass AI projects that have nothing to do with AI. You read into it, it's like blah, blah, blah AI. And you read into it, there's no AI here. You guys just have some server farms in Bosnia. Yes, AI. No, that's not AI. That doesn't make it AI. We put AI in the title. It's very clearly an AI project. You're going to get rich. Get rich with us. Yeah. Let me guess. Token burn comes next. Anyway, so that's my take on the news. And that gives you a little window into how I look at this stuff. First, I read the news. Then I try to put on the bullshit filter and go back through the same news and unbullshit it. And there's usually not much there. Is Fetch being inorganically pumped? Well, we can take a quick look at it before we get into our discussion, our deep classroom discussion. Well, let's go look at old Fetch. Let's see about this. Whoa, let's look at the 24-hour. It doesn't look completely stupid. Let's look at the 30-day. Grinding. Wow, that's a lot of volume. That is a lot of volume. You see that's comparatively, it's 50% more volume than when it reached its all-time highs. No, sorry. That was the near all-time high. It's what was the best day? Okay, so it's about 50% of that volume. Let me go back. That was about 1.2. Oh no, it's about 60-65%. Although I will say this, look at that. It's a much smoother line. This is the marketing machine, not the scammy pump machine. And remember, AGIX and Ocean will necessarily follow it because they're pegged now. 0.4332 and 0.43332 or something, that almost to like the 10,000th. So, oh wow, you exited AGIX was 120. Oh, good for you. I trimmed a lot, and I just left it in cash. And I refuse to go back into these assets. It's like I pulled the money out. I'm going to leave the money out. It was a rules-based exit, and I don't want to dummy back into any of these things. So right now, the way I'm looking at it is I'm getting Fetch. I'm getting those rewards. I sell those rewards every day, by the way. Not every day, about every 2 or 3 days. I transfer them to Kraken, and I sell them, and that's what I use for my dollar cost averaging. But I'm just not confident re-entering any of those. I'm glad it's back up. 20% seems amazing, seems miraculous, given that Bitcoin is flat and that Ethereum is flat and that pretty much everything else is flat. I'd say 20%'s a hell of a day. So there you go. Could it be some pumpiness of AI? I don't know. Not all the AI assets are really moving. So I can't say it's a pure AI play because Render's the spammiest of the AI plays. Oh, by the way, Render, you look up all these different articles about, what is the next big data play? Somehow Render's in there. Oh, what about AI? Oh, Render. Oh, what about data protection? Oh, Render. What? Wait, so Render's everything? Is it a layer one? Is Render the next Bitcoin? This is, I don't know the price of Render. I don't know how a company with, I guess with a bunch of Hollywood douchebags, that's how you have a $3 billion valuation. There's really no other reason that this spammy ass company, but they got a lot of mouthpieces and they get on and they pump it all the time, CNBC and everywhere else. So it is what it is. Question. Do you have any thoughts on layer ones that seem to attract gaming coins? No, because I I don't know. Avalanche, I used to have Avalanche, and then they got into that crap where they hired a law firm to do some really shady stuff. And I was like, against like other layer one projects. I was like, you know what? I don't know, man. I think I'm out. I exited that one because the team seemed sketchy. They immediately went from a 5 to a 1 on the 5 Ts, and that took it out of being even a trade for me. So I got out of Avalanche. I had Beam, got out of it. Emulex, or that's not Emulex. That's my brain's going back to when I got my ass kicked because some kid put out a fake quarterly report on a company and it tanked the company, and then I got sold out by. I had stop losses in, and the stop losses didn't execute. This is on E-Trade, and then they executed like $40 below. And then the price recovered the next day when they said that the kid was pulling a scam, which made me think that it was probably not just a kid pulling a scam, but kind of an organized scam. And then I ended up, there was a big class action lawsuit against E-Trade. They had to actually settle with a bunch of people. Anyway, that's where I was thinking. Yeah. So layer ones that attract gaming coins. I mean, I don't know. Games of the future need to run on really fast rails. In my mind, they would run on something closer to like a hypercycle for certain parts of that, just because they can run so many transactions so fast. Most of these layer ones are not really kind of fit for purpose for video games and things like that. I mean, now if you're talking gaming coins like gambling coins, I don't mess with gambling. I know that gambling's big business. I just don't think online gambling, again, if that's what you're referring to, I don't think online gambling needs to be on any, immutable. I know, I knew a dude that was with them. Anyway, doesn't matter. So if you're talking online gambling, I don't know that they couldn't just run everything that they do right on Ethereum. Like you don't need those softwares that they use for online gambling. You're just talking about payout. So remember, you're just reconciling payouts. You don't need a fast blockchain for that. And they're going to defer to whatever's the kind of the staple, and that staple asset would be Ethereum, I would think. So yeah, I just don't think gaming's all that interesting for crypto. And again, what are you using it for? Settlement, right? You're not running the game on crypto rails. You're using traditional compute for that. So I don't know what benefit it would be. I just don't know. I don't see it. So that's my thoughts. My thoughts are I don't have that many thoughts. Do you believe BTC pump is lurking? I don't think a pump is. I think it's coming because, just my guess is these miners will exhaust their resources at some point, and when they exhaust their resources, that's that. And then you don't have that sell pressure. Even if it's OTC sell pressure, those are still people that are buying on the OTC would have to be buying somewhere else. So when the OTC sales exhaust and the miner sales exhaust and those companies go out of business, companies that can't survive go out of business, and it makes the world a better place for companies that can survive, for companies that did do better math and that did do better forward projections and looked at their infrastructure spending and their manpower and their fixed and capital costs and things like that, and that were wise. So bad businesses are supposed to go bankrupt. They're supposed to go away, and those assets are supposed to end up in the hands of better investors or better businessmen or better businesses. This is why you need recessions and you need depressions every now and then. People that behave badly, banks that behave badly, financial institutions, companies need to go bankrupt. Some people need to go to jail. That needs to happen. You need to clear out all the bad stuff. You need to purge the poison every now and then. So those things are healthy. When you paper over, problems like governments tend to do, you don't solve the problem. Putting a piece of tape over the low oil light on an airplane is not good. That is not a good idea. Right? And if you're driving uphill, you can ignore the brake light. Once you're going downhill on the other side of the mountain, the problems with your brakes might become pretty substantial. So you need things to clear out. And so I think as the miners clear out, the bad businesses go away, the bad management goes away, bad companies, those assets end up either with somebody else or in a scrapyard, then the Bitcoin mining ecosystem is stronger. And then there's less, well, there's no OTC selling when they run out. It's over with. But as you saw, there's still plenty of Bitcoin for miners to sell. So the question is, when does retail, when does Joe Sixpack step up? That's marketing. That's mostly marketing. I thought Bitcoin would have already been moving. I guess I underestimated how stupid miners were. I just thought after the third rodeo, they would understand what it takes to get on and off a damn horse. And apparently they don't. Apparently it's a bottomless well of stupid, of poor money managers. C'est la vie. Okay, macro question. How are small cap stocks holding on in this higher for longer interest rate? No, not well. I mean, no one's doing well. It's all, that's a longer discussion for another day. But also this interest rate environment, banks are having some trouble with it, carry trade banks and things like that. Banks that, like in Japan, I was listening to a thing where they were talking about how a lot of banks in Japan were making money on the carry trade by basically borrowing dollars and then borrowing against those dollars to buy government debt and collecting the spread on a kind of version of a carry trade. And then now that's not working because their cost to borrow in the short term, borrow short, lend long, it's not working because you have an inverted yield curve. So you can't borrow at 5% to earn 4%. It's not sustainable business practice. So yeah. But smaller companies, I mean, I don't think the interest rate environment affects them. I think the state of the economy and the state of the consumer, and I think that's what affects them. And you either sell widgets or you don't, or you made too many widgets and you have to discount them, or you don't have enough widgets and the price goes up. And then people decide if they want your widgets. And yeah, I just think I don't think interest rates are all that important. It's a way of looking at the markets, not what the Fed says, but how actually money dealers work. And the yield curve is a very interesting indicator for what the state of the economy and what people that actually deal with money think. I think that's incredibly interesting, but I don't think the actual interest rates, especially to like smaller companies and things like that, I just don't think they matter that much. If the difference between 3 and 5%, or 1 and 2%, or 2 and 3%, if that's what's bankrupting you, then you're not a real business. You don't have a sustainable business. Yeah, I heard Ilya is starting his new company. Super safe. The safe. They said, we have a lot of concerns, but one of them is not raising money. Okay. You think a lot of people are just going to throw money at you guys to have a super secret company that has no product? Yes. All right, well, cool. Cool, man. That's awesome. That's great. When will commercial real estate collapse? It's kind of collapsing. I think it's collapsing right now. How will it affect crypto? I don't. Well, everything affects everything to an extent, but I think that the commercial real estate collapse is a known unknown. It's a known at this point. I don't think it's going to shock anybody, and it's collapsing. It's not like tomorrow everything's collapsed, but today everything's fine. I mean, there's little banks getting whacked all the time. There's companies getting whacked all the time. Lines of credit getting pulled back and things like that. That's happening all the time. I think everybody just kind of seeing it. Yeah. So there you go. Yeah. All right. Maybe the ASI keeps the peg by trading amongst themselves. No, I mean, I don't know, maybe, but I don't think so. I think that that's just people arbitraging the ratio. Um, and because I think, Howard, it's because you know that if fetch goes up, then you would be getting more fetch for your AGIX tokens. So basically, the price of those goes up to maintain that 0.4332 whatever ratio of trade when they open up these bridges, if they get around to it next month. So I think they'll probably push it again because I think these guys are just a bunch of boneheads that can't get out of their own way. But that's neither here nor there. Who knows? Maybe they're trying to internally, I don't know. They don't have enough money to, I don't think these teams all together have enough cash in a bucket to deploy it in such a way, especially managed by Mario and the idiots over there. There's just not enough money for them to peg these things themselves. Just not. They don't have the money. There's no money. So I just think it's good. It's just the marketing machine getting spun up, and then people trying to kind of stay arbitraged. I mean, think about all that it would take to maintain a peg on your own with your own money. At some point, you just run out of money. And these are not companies with a bunch of money. They just don't have it. So, yeah. I mean, the whole point of ASI is so they can pilfer, not so they can make the world a better place. All right. Let's switch gears. We got to talk about gambling, at least for about 5 minutes, 5 or 10 minutes. We got to fill your brain with, goo, some good brain goo.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
All right. So let's talk about the gambling mindset and the longer term investment mindset. So brains versus bets, psychology of gambling versus long-term investing. We're going to dive in. It's pretty interesting. I was reading about this yesterday. I thought this is a good thing we should talk about. Because I harp on it a lot. And I tell people, if you go down the meme coin path, if you go down the YOLO path, the investor nihilist path, it's one way, and you probably won't come back from it. And I've seen people descend into this investment chaos. Anyway, it's interesting how the human brain works and how they relate. And so there's two very different activities. So gambling versus long-term investing. So hopefully in the next 5 or 10 minutes, you're going to understand why it is difficult to effectively practice both mindsets and why you kind of need to decide which one is more important. And you just need to pick one. And whatever you pick, good for you, but you need to pick one. So let's do some defining of terms. Gambling involves taking risks with money on outcomes that are uncertain, often in games of chance, like poker, roulette, sports betting, and meme coins. Long-term investing, on the other hand, involves putting money into assets like stocks, bonds, digital assets, real estate, investment income, or assets with the expectation of generating returns over a longer period, and not meme coins. While both involve money and risk, the psychological and neurological underpinnings of these activities are very different. This is where it gets kind of, it's where the goods come in. Goods. So the brain and gambling. Remember those commercials? This is your brain on drugs. They just throw like some eggs in there. And then I saw another one was like, this is your brain with a little bit of cheese and some bacon. And they like threw cheese and bacon and made an omelet. I was like, oh man, that brain looks delicious. Anyway, this is your brain on gambling. When you gamble, specific areas of your brain light up. And the key players here are the limbic system, particularly the amygdala, and the ventral striatum. Limbic system and amygdala. Say, what are these crazy parts of my brain? Well, the limbic system is often called the emotional brain. You should already be thinking, oh shit. That's right. The amygdala, a part of the limbic system, is responsible for processing emotions like fear and excitement. So when you gamble, your amygdala is highly active, right? And it's reacting to the uncertainty and the thrill of potential rewards. Then you have the ventral striatum. I'm sure I'm pronouncing that wrong. And dopamine, which, yes. So the ventral striatum, including the nucleus accumbens, is crucial for the reward process and for reward processing. So when you gamble, it releases dopamine. You guys, most people know this. Gambling releases dopamine, which is a neurotransmitter that makes you feel pleasure. Yeah, man, like dope, right? Dopamine. And this dopamine rush can lead to a feeling of euphoria, which is why gambling can be so addictive. It becomes a dopamine drug addiction, an addiction. And then you have immediate gratification, right? So gambling activates the brain's reward system, releasing dopamine, which leads to immediate gratification. You win or you lose right away. And that instant feedback loop is very stimulating for the brain. Again, why this becomes an addiction. And I don't know too many good addictions. That's why they call it addiction, because it's so not good. Anyway, so let's talk about the brain on long-term investing. So let's put some cheese and some bacon on it. When you're thinking about long-term investing, it involves a different set of brain regions and a different set of psychological processes. So we're not even in the same area of the damn gray, right? So now we're dealing with the prefrontal cortex. Prefrontal cortex, which is at the front of your brain, is responsible for decision-making, planning, and self-control. Those things are important. Those things we like. When you invest for the long term, kiddies, you rely heavily on this part of your brain, again, the prefrontal cortex, and it helps you evaluate information, consider future outcomes. It helps you resist the urge for immediate reward. I mean, the greatest tool you can teach anyone, including yourself, is delayed gratification. And delayed gratification, it requires patience and the ability to delay a reward, to put a reward off until a later date for a greater reward. So you're not looking for an immediate payoff. You're willing to wait days, weeks, months, years, not minutes or hours, for your investments to grow. And this requires a very high level of self-control and foresight. And most people, they have degrees of it, but not quite enough. So also playing into this is risk assessment. So long-term investors, especially successful ones, engage in fundamental analysis, assessing the intrinsic value best they can of the assets that they might invest in, right? So this is even before we invest. And this analytical thinking involves the prefrontal cortex and requires a rational evaluation of risks and rewards over time. Say it again, a rational evaluation of risks and rewards over time. It happens in a different part of your damn brain. There's a reason. Gambling is so bad that it's like sequestered. It's like off in the basement. You go to the basement, gambling. Anyway, comparing and contrasting these mindsets. So you have emotional versus rational. Gambling is driven by emotions. Where in game theory do we have emotions? Oh, that's right. We don't. Gambling is driven by emotions and the pursuit of pleasure. Investing, on the other hand, it's more rational. It's an analytical process. Again, different part of the brain. The emotional highs and lows of gambling can cloud your judgment. Matter of fact, it clouds judgment moving forward. That's why they'd like beat up their spouses and everything. Anyway, while successful investing requires a clear, level-headed, consistent approach. So then you have, okay, fine. We looked at emotional and rational. Let's look at short-term versus long-term. Gambling focuses on short-term outcomes. Each bet is a discrete event, a finite event with an immediate result. Investing looks at the bigger picture, focuses on long-term growth and stability. The long-term perspective can be more challenging, obviously, to maintain because you have to be consistent with the research process, but it is essential for success, right? Then you have impulsivity versus patience. Gambling can foster impulsive behavior in all areas of your life, not just in your gambling investments. As the constant stimulation and potential for quick rewards encourage very snap decisions, that kind of behavior starts to propagate out into your daily life. Investing, on the other hand, requires patience and the ability to stick to a plan even when markets around you might be volatile. This also propagates out into your life, where you become more of a strategic thinker. You start thinking more long-term, less finite, and more infinite. And so here's why you can't effectively practice both mindsets. Now, everybody in here is like, oh, no, I can't. I'm the one-off. Yeah, I get it. Everybody in here is special. Everybody here is the one human on the planet that's got this figured out. Everybody else, they can't, but like, come on. So you have neurological conflicts, psychological consistency problems, and behavioral conditioning problems. So the neurological conflict is the parts of the brain involved in gambling and investing work against each other. So the emotional rush from gambling undermines rational decision-making needed in the prefrontal cortex. Conversely, the discipline required for investing can be eroded by the impulsivity encouraged by gambling, right? What is the psychological consistency problem? To be clear, to be a successful either gambler or investor, you need psychological consistency. Switching between the emotional highs of gambling and the rational calm of investing can create cognitive dissonance, making it very difficult to excel at either of these. Turns out you actually cannot do both of these. Now, some of you may have been lucky. I know a lot of people that are they're lucky. They gamble, they're lucky. And, they leverage some advice, but they're gambling. And that's consistent in their behavior, that they are gamblers. And gamblers, some of them may statistically gamble their way to success, but they will most likely squander because of those same behaviors. That's the problem too. It's that it propagates out into the rest of your life. So it's not just that you gambled. You can gamble to make money, and you will continue to gamble in the rest of your life and give it away. Just through gambling behavior. And so it makes it difficult to excel at either of these actions. Behavioral conditioning. So your brain gets conditioned to the activities that you engage in. So if you're a frequent gambler, you're conditioning your brain to seek immediate rewards, to seek that dopamine rush, and to make decisions like that. So it makes it harder to stick to long-term investment strategy. Well, you can't. You don't have that capacity. You don't have that ability. And then on the flip side, cultivating an investor's mindset can make the unpredictability of gambling much less appealing. Remember, who was telling me? Someone's like, you play the lottery. I said, no, I don't play the lottery, you tool. They're like, well, if you don't play, you can't win. I'm like, if you do play, you can't win, stupid. Anyway, because math. Anyway, so long story shorter, those of you, whether you're kind of in your investment lives or on the brink of kind of formulating your investment strategy, like how you're going to kind of invest for the rest of your whatever investing means for the rest of your life, you're at a very crucial juncture where your financial habits and mindsets you're in the formative years of investing. So it's important to recognize the difference between gambling and investing and understand that excelling in gambling will make you a bad investor. Excelling at investing will make you not want to gamble. You cannot do both. You cannot. You're not the one. You're not a unicorn. You're not a beautiful, unique snowflake. Like, stop with that. I mean, you're just not. There's someone out there. Right now, someone's like, no, he doesn't. I can keep them compartmentalized. No, you can't. Because math, because science, because physiology and biology make it so. You're not an anomaly. Anyway, ask yourself what your financial goals are and which approach aligns best with your goals. If you're aiming for quick thrills and you're willing to accept the risk of losing everything. Remember the guy that we were talking about? What was it? Crypto nerd. 3x Pepe. He'd been in crypto since 2017 and built up over $1 million. And then he had a 3x leveraged Pepe position and he got completely liquidated to zero. And now he's on suicide watch. Good. He's a fucking idiot. That's what you get. He got what he wanted. That doesn't seem appealing to me. Some people, maybe it does. If you're looking for steady long-term growth and are willing to be patient, investing is the better path. Plus, you have compound interest effects on your side. So, success is either, understanding your brain and what you want and what your personal psychology is, or choosing the path that aligns with your goals and your temperament. Like for me, recently, I started cutting my caffeine down because it was making me too snappy. And I realized that's going to affect all of my decision-making, not just like my, crypto investments and other investments and stuff like that, but like it's going to affect your interpersonal relationships and everything else. So again, you're dealing with different systems. Smart, competent decision-making, responsible self-control, that's in the prefrontal cortex. Gambly, spammy, memey, bullshitty behavior, it is what it is in the limbic system in the amygdala. I need my reward now. You can't do both. And if you find yourself thinking you can do both, you ain't lying to us, bro. You lying to yourself. Sometimes, like, you might invest in some asset, and not to go into it too deep, but essentially, the reason I get frustrated when people invest in dumb stuff, it's not the money side of it. It's the mind side of it. It's the fact that you are using mental resources in either the limbic system or the prefrontal cortex. Since you can't do both, you're robbing from one to go to the other. That's going to influence the rest of your life. So if you leave competent, sound, consistent decision-making, it's not just like, oh, I'm YOLOing, bro. YOLO. Come on. I'm living my best life. No, you're actually influencing your thinking moving forward because you've shifted thinking to a different part of the brain that functions under different constraints and rules. You will poison your game theory with gambling behavior. That's it. And it's not just this isn't like theory. This isn't my thoughts about it. This is the biology of the brain. So there you go. You do you. But don't whine about it later. Oh, man, I shouldn't have done this. I shouldn't have done that. This stuff, listen, man, investing can be very easy if you're willing to do a little work. Or it can be very easy to lose all your shit. Anyway, stay in school. Don't do drugs. Don't do anything about poor, insolvent, drunk, strung on meth, grandmother, grifter-ass grandmother, who you can only talk to with a Ouija board right now. Would do. Brandon's probably wearing sleeves because it was cold yesterday. He was telling us there was like a freeze warning in June. Get off the gas. I ain't living nowhere where there's a goddamn freeze warning in June. I'm up out.
If you're an accredited investor and you want in on angel, seed round or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.